All right, let's just jump right into this explainer. I want you to start by thinking of the stock market not as some chaotic, confusing jumble of numbers, but actually as a foreign language. Honestly, it's just like learning Spanish, Hindi, or English. To get anywhere near fluent, you absolutely have to know the alphabet first, right? Well, in the world of professional trading, price charts are that alphabet. So today, we're going to decode this visual language together, step by step, so you can actually sit down and read exactly what the market is trying to tell you. Here is our game plan for today's masterclass. We'll cover 1. The market's language. 2. Anatomy of a candle. 3. Bullish reversals. 4. Bearish reversals. 5. Indecision and continuation patterns. And finally, 6. The fluency test. Okay, let's kick things off with Section 1, the market's language. A lot of beginners just open up their favorite stock app and look at a standard, plain line chart. But here's the thing. Line charts really just show a squiggly up and down line based solely on closing prices. You literally cannot do deep technical analysis with that. Professional traders, on the other hand, use Japanese candlesticks. Why? Because a single candlestick tells a highly detailed, time-stamped story of market behavior. It captures the absolute highs, the terrifying lows, and the ultimate final decisions of both the buyers and the sellers. It's a game changer. Moving right along to Section 2, Anatomy of a Candle. So before we can read full sentences, we gotta learn our ABCs. Every single candlestick tells you 4 highly specific pieces of information. Let's imagine a stock called, say, Purab Company. If the market opens and the stock starts out at 10 rupees, bam, that's your open. But suddenly it drops down to 7 rupees. That's your low. Then out of nowhere, buyers step in, they take control and push it all the way up to a peak of 15 rupees. There's your high. Finally, the trading session comes to an end and the price settles at 13 rupees. That's your close. This entire life cycle right here, that is what builds the very shape of the candle. And that open, high, low, close data, it perfectly dictates whether we're looking at a green candle or a red candle. A green candle obviously means profit. The price went up. So, logically, it opens at the bottom of the thick part and closes up at the top. A red candle means the price fell, so it does the exact opposite. It opens at the top and closes way down at the bottom. Now, that thick colored block in the middle is called the body. That represents the core price movement for that time frame. Those thin little lines sticking out of the top and bottom, those are the wicks, or shadows. They show you the extreme price rejections. And honestly, the best part about all of this is that this exact anatomy applies to absolutely any time frame you want. You could be staring at a 1-minute chart for hyper-fast day trading or a 1-month chart for long-term investing. The ABCs literally never change. All right, Section 3, bullish reversals. Let's meet the main characters of our market language. Think of an actual bear for a second. It sleeps in its dark cave and falls heavily to the ground, which tells us a bearish market goes down. Conversely, a bull is this aggressive, powerful animal that charges forward, tossing things way up in the air with its horns, so a bullish market runs up. When we are hunting for bullish reversals, we're basically looking for specific patterns that tell us a sleeping bear market is about to wake up and start charging like a bull. So let's look at the core vocabulary here. When a market is falling down, 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 seeing one of these bullish reversal patterns is a huge signal. It indicates a really high chance that the trend is about to flip. First, you've got the hammer. It looks exactly like a mallet with a long handle pointing down. And hey, color doesn't even matter here. Then there's the inverted hammer, which is just that same mallet flipped completely upside down. We also have the bullish engulfing pattern. This is a fun one. It's where a massive green candle completely swallows the previous tiny red candle, basically screaming that buyers have taken over. And finally, the piercing line. This is where a green candle gaps down, but then aggressively pushes back up to cover more than 50% of the previous red candle's body. Now, moving from 2 candle setups to slightly more complex 3 candle setups, we get some wonderfully visual names. First is the morning star. I love this one. Just think of it like the literal sun rising after a dark, falling market. Second, we have the 3 green soldiers. Now, traditional old-school textbooks will call these the 3 white soldiers, but let's be real. In modern digital charts, green means profit, so green soldiers just makes way more sense. Okay, let's take a quick second to test your visual fluency. Picture a falling market, right? You get a big red candle, then a tiny, kind of indecisive candle at the very bottom, and then boom, a massive green candle erupts, covering over half of that initial red one. So is this a morning star? If you just answered yes, you are absolutely right. The darkness has broken and the sun is finally rising. Moving to Section 4, bearish reversals. So the really great news about bearish reversals, if you understood those bullish patterns we just covered, you already know these. They are the exact structural opposites. You don't need to memorize a whole bunch of complex new rules. A bullish engulfing at the bottom of a chart simply becomes a bearish engulfing at the top. The piercing line becomes the dark cloud cover, and that beautiful rising sun of the morning star, well, it becomes the fading light of an evening star when a long uptrend finally gets exhausted. It is entirely about the context. When you're looking for bearish reversals in action, you are looking for a market that has been running up super aggressively, and then suddenly, at the very peak of that run, you spot a bearish hammer, which a lot of traders call a shooting star or an inverse bearish hammer. Remember, just like before, the specific color of this single hammer candle doesn't strictly matter. If you see that shape with a super long wick at the top of a massive run-up, it means the buyers tried really hard to push higher, totally failed, and now the bears are waking up from their hibernation. Let's do another really quick quiz. The market is flying high, everyone's making money, everyone is happy, and then suddenly, out of nowhere, the chart prints 3 massive, solid, consecutive red candles just stepping right downward. Are these the 3 red soldiers? Well, seeing this intense downward force after a big uptrend is indeed the classic pattern, sometimes called 3 black crows, and it absolutely confirms a massive downward turn in market momentum. Section 5, indecision and continuation. Now, let's see how the market communicates when it honestly just isn't sure what it wants to do. Sometimes the buyers and the sellers are perfectly matched, a total tie. When this happens, you get what's called a doji, or a spinning top. These are basically candles with a tiny, almost non-existent body in the middle, but really long wicks on both the top and the bottom. It looks exactly like a little spinning Beyblade or a whirlwind. When you spot this, it is pure indecision. Neither the bulls nor the bears have control. The market is just holding its breath, waiting to fall one way or the other. But hey, what happens when the market isn't reversing, but is literally just catching its breath? Enter the continuation patterns. Now listen, these love to trick impatient traders. Take the bullish 3-line strike, for example. The market is rocketing up, then it pauses, prints 3 small red candles. Amateurs completely panic and sell out, thinking it's a massive reversal. But then, a massive 4th green candle swallows all those red ones up and rockets the market even higher. You absolutely must wait for that final massive candle to confirm the strike. The trend wasn't dying, it's simply continuing. Finally, Section 6, the fluency test. Okay, you now officially have 16 core candlestick patterns in your trading vocabulary. But how do we actually apply this grammar out there in the chaotic live market? Well, here is probably the most important lesson of this entire explainer. Candlestick patterns deal in probabilities, not absolute guarantees, period. Just because you see a morning star doesn't mean the market mathematically has to go up. It just means there's a much higher chance that it will. And this is exactly why professional traders never ever rely solely on candlesticks. They combine this visual language with broader price action analysis and really strict risk management. True fluency takes real practice, so I'm actually giving you some homework today. Don't just watch this and move on to the next thing. I want you to open up some live charts on your computer, whether that's HDFC, Reliance, Tata, maybe your favorite tech stock, whatever it is. Scroll back through the history and hunt down these 16 specific patterns in the wild. Finding them organically yourself is exactly what builds your visual memory and makes you a much faster, much sharper trader. We have completely decoded the language of the market today. You've gone from looking at weird, confusing squiggly lines to actually understanding the fierce psychological battles happening between bulls and bears, all mapped out in red and green. But look, knowing the alphabet is really only step 1. The charts are out there talking right now, every single second of the trading day. So the only question left for you is, are you finally ready to start listening? Or will you just let the market keep speaking a language you ignore?